Morning, everyone. It is Tuesday, January 18th. Our note this week released on the 15th, the beginning of the Martin Luther King weekend holiday, was titled Earnings Good, Fed Bad. There's three sections to note this week. There's a market recap. Was a very curious week in terms of how the markets responded to the stronger than expected CPI numbers, the weaker than expected retail sales numbers. And so we walked through that. We also wrote a section on the inflation report, all about inflation correlation. And then the final section in the note this week was an earnings preview titled Peak Margins with a question mark, because it seemingly expectations from bottoms up fundamental analysts are that margins are going to actually contract somewhat in the first quarter. And we've heard that from a number of strategists as well. And we're going to talk about that a little bit also. So to begin with on the markets, that section was titled Earnings Good, Fed Bad, which was, of course, the title of the overall note. The market on Wednesday after CPI acted as if it was peak inflation. And we found that a very curious response, in particular with oil climbing through the course of the week to settle at 83, 82 level that is just shy of its highest post shale oil crash level. You also saw copper moving up, industrial metals moving up. All of these things are not really indicative of peak inflation to see commodity prices moving forward. But furthermore, there was lots of reasons, and we'll come back and talk about inflation in a little bit more depth in a minute. There's lots of reasons to believe that while sure, goods prices will peak sometime in 2022, presumably in the first half, it looks like inflation is going to settle in at levels much higher than the Fed expects, and levels higher than most street economists expect as well, would be our expectation. So that part of the reaction may have been related to some of the most notable doves on the Fed capitulating and talking about rate hikes and balance sheet contraction. We saw that from Mary Daly. That's been going on for several weeks now. Lael Brainard's congressional testimony for her hearings to be named vice chair for monetary policy of the Fed. She sounded fairly hawkish and very concerned about inflation. And of course, the most dovish Fed president of them all, Daly and Evans in Chicago, had a very similar line of reasoning, which is Fed's going to have to raise rates and probably start contracting their balance sheet. So we just didn't think it made a heck of a lot of sense for the market to turn around and respond as if that was peak inflation. Of course, it rolled over hard on Thursday, but did reverse on Friday. We'd have to say, though, the probability of getting that 8 to 12% correction that we were talking about from the summer and expecting to occur when the Fed started the process back in the fall, of course, it only turned out to be a 6% correction, but the probability of getting a bigger risk-off event is definitely going up. Now, earnings season, we do think will be a net positive, but we've got quite a number of events coming that are of major importance. One that you should not overlook would be the employment cost index. That'll be the week after next. And that was probably the one number that shocked the Fed the most when that came out last fall and got them to really accelerate the taper and start thinking about much more hawkish policy. So that's notable for sure. We're going to get GDP. And of course, we have a Fed meeting, and Chairman Powell, no doubt, in that press conference is going to sound pretty hawkish, whether they take any concrete additional steps at that late January meeting or not. Certainly March is sort of D-Day for the Fed. One important or a couple of other important points to make about the market action. We do think that the economy is not going to respond negatively to the Fed starting to normalize policy. They're essentially going to be removing counterproductive policy in the early stages. So there's not going to be any pushback. I know some of the narrative around the retail sales number on Friday was, well, retail sales inflation is so high that you may have got consumer pushback. we dispute that. They had they, meaning the Commerce Department, had a real problem with seasonal adjustment factors last year. And when you listen to retailers, they had a blowout Christmas, but the retail sales number looked like it softened in November and December. Exact same pattern. You can see that if you were a subscriber to our notes. We published the non-seasonally adjusted numbers against the seasonally adjusted numbers, and you can see the NSA numbers surging and the seasonally adjusted numbers going down a little bit. So I think the government's having a problem with changes in spending patterns during the pandemic. Understandably so. It's not picking on the pencil pushers at the Census Department here. I'm just saying that we think that you probably get big upward revisions, and you really haven't had any slowdown in consumption in our view. And we think we'll probably hear that from retailers when we get to them. Their reporting of numbers in February. One final point to make as well on this market section was we did see a note this week about the Volcker Fed having been very frustrated when they raised the funds rate to 20%, that the longer term rates didn't come down as much as they would have expected them to do so. That strikes us as the same problem as the Powell Fed is having today, where you'll hear Fed officials say, well, gee, if inflation was really a problem, then we would expect to see that in long-term inflation market-based expectation measures. Fed policy is preventing long-term rates from moving up, including break-evens. We've discussed a lot the huge divergence between real rates and break-even rates, but it's capped the same way those rates, bond yields had a floor on them during the Volcker era when the Fed funds rate was 20. The steepest the yield curve ever got, 3-month to 10-year, and flattest it ever, or most inverted it ever got, both occurred in that Volcker era. But we're talking about 2.5% versus 4%. There's only so far it can go. So those are goofy arguments. When you hear those, just run away. So that's it. Again, the risks we think are building for a bigger correction here. On to the inflation numbers. We titled that section of the note, "Correlation is not causation, but." And the reason we said that or wrote that, made that the title, is because we have this correlation matrix that we use for CPI, the 20 major components of CPI, and we are now at the highest level of correlation between the components of CPI that we've been at since the 1970s. So this is a very broad-based surge in prices. We've talked continuously about transitory services disinflation. Well, that's dissipating somewhat. We see medical care starting to rise, still has further to go. Education has not gone up. Housing is starting to surge. That's going higher still. We think as those goods prices come down in the spring, the Fed's going to find themselves chasing services inflation, which is now up to 3.7% and is likely headed significantly higher. So the Fed is in a real heap of hurt here with respect to inflation. And yes, we may have seen the highest prints, but it's not coming down to anything like the Fed's forecasts based upon what we're seeing from the way we look at this, with correlation being a key way that we approach thinking about this. Furthermore, we got the Atlanta Fed wage tracker last week. And what we saw there, the previous week, we talked somewhat about whether wages were being driven up by dynamism, turnover, people going to get new jobs, quitting their jobs, getting new jobs, or it was being driven up by slack. The Atlanta Fed wage tracker allows us to look at that as well. We look at what we call the wage differential, which is the lowest quintile of income earners versus the highest quintile. That's at its biggest spread since the 90s. That's a measure of slack or lack thereof. And we also look at switchers versus stayers. That's moving up, but not as aggressively as this lowest quintile versus highest quintile. So with the Atlanta Fed wage tracker, it looks like diminished slack is driving wages more so than our approach, which is to look at worker reallocation. Either way, wages are headed up. And again, the Fed has a big problem. So finally, moving on to our earnings preview and this idea that we're getting peak margins. It's understandable why bottoms up fundamental analysts would think that we're getting peak margins. Wages are going up, costs are going up. But we believe that there is a significant amount of operating leverage that remains. And the fourth quarter 21, the numbers we're getting now forecast, according to Refinitiv, of 22% earnings growth on 14% revenue growth, which is fantastic. Just shows you how high nominal GDP is right now, is going to transition to 8% earnings growth on 10% revenue growth in the first quarter of 22, with a lot of that margin compression coming in the technology and technology related sectors. And we think that that's probably wrong. Although we're not overweight technology any longer, we're going to have a capital investment boom. Technology is going to be right in the forefront of that next year. There's still strong operating leverage. We do not think margins are going to begin to contract. We heard that all last cycle. Margins typically will contract 2 to 3 quarters prior to a recession, at least an earnings recession, if not outright economic recession. We don't think we're likely to get one in late 2022 or early 2023. Obviously, we've written a fair bit about that. We wrote about it in our macro trends for the 20s. Already, we do not think the business cycle is going to end. But the risks are significant. We understand why analysts came out the way they came out. There's still, we think, a fair bit of upside to industrial sector margins this quarter. That's one to watch for sure. And then on the banks, we like the regionals better than the big money centers right now. We saw what happened on Friday. We got a good reaction in Wells Fargo, not such a good reaction in JP Morgan. We're going to get a lot of regional banks reporting numbers. Both Powell and Brainard talked about getting SLR relief. That's the supplementary leverage ratio that's been binding in this abundant reserves regime that we're in. We were thinking that that would not happen until you put the vice chair of supervision in place. The Biden administration has made those nominees. We may get it sooner than that, but that's likely to come. That has created a problem for the banks. After every earnings report for the last few, they've had to sell quite a bit of notes just to get the capital structure back in line with that supplementary leverage ratio. It's just cash is a problem for them. So that could be good news for the banks as well. And we think the regional banks in particular will act well through earnings season. So we'll write more on earnings through the process. That's it for me this week. Again, earnings are good, and we think they're going to continue to be good. The Fed still holds out risk of us getting a deeper risk-off event because of aggressive policy changes. And as I'm recording this on Monday night, you could see that the curve is up about 4 to 5 basis points in the belly, from 2s out to 7s or so. So there's a lot of pressure on rates right now. S&Ps are up a little bit, but again, the probability of a risk off is going up significantly. That's it for me this week. Barry Knapp from Ironsides Macro. If you're not already a subscriber to our research, we'd encourage you to become one. We will be making some changes to the podcast. We should get that done this week. You'll hear about that next week. Have a good week, everyone.